Good day, friends. By the end of this presentation, you should have a pretty good idea about how Warren Buffett views the stock market. Hi, I'm Gordon Weeb. I'm a licensed underwriter in the provinces of BC, Alberta, and Saskatchewan. I help clients achieve their financial goals and objectives, typically through the use of annuities. Over the next 10 or 15 minutes, we're going to review how Warren Buffett sees the stock market and how it might help you when it comes to your financial planning process. Just before we begin, regulations require the following safe harbor. This presentation is produced and published on and around August 10th, 2020. It is for illustration purposes only. And even though the topic of this presentation is, quote, the markets, unquote, viewers should know I don't have the foggiest clue what they'll do in the short term, nor for that matter does anyone. This is not an offer to purchase securities or products. No representation is made. Items presented may not be suitable for everyone, and values will fluctuate, sometimes wildly. Please consult an experienced, qualified licensed professional prior to investing or employing strategies to ensure that your investments are a part of a comprehensive plan designed to help you and your family meet your long-term financial goals and objectives. Also, when recommending products and planning strategies, broad tax and legal issues may be discussed. Nothing should be construed as tax or legal advice. There, now that we've navigated that passage, let's move on. Here's our agenda. Number 1, we'll review an article penned by Warren Buffett and published in Forbes magazine some 20 years ago. A link to the article can be found in the notes below. Number 2, we'll summarize the key points of the article. Number 3, we'll analyze current market conditions. Number 4, we'll examine some of the potential market risks. And number 5, we'll provide a brief action plan and ways you might help mitigate some of the potential risks. Here's some background. Allen & Company is a boutique U.S. investment bank that was established decades ago. Every year, they host a retreat in Sun Valley, Idaho for the affluent clients and their prospects. In 1998, Warren Buffett gave a presentation on the stock market, a topic he rarely discusses, so when he does, everyone should take notice. At the time, the investment world was in the middle of the dot-com bubble. Buffett was dismissed by some as a has-been, and his emphasis on value and business fundamentals contravened the fast money schemes and the conventional wisdom of the day. His friend and contributing Fortune editor, Carol Loomis, recognized the value of the presentation and helped him transcribe the presentation into the Fortune magazine piece that is there for all to read. Buffett begins the article by comparing the Dow Jones Industrial Average during two 17-year periods, beginning in January 1965. During that first 17-year period, the Dow Jones Industrial Average rose from 874.12 to 875, or about 0.1%. That's a long time to be waiting for satisfactory results. I should know. Coincidentally, that period represents the first 17 years of my life, from the time I was born until my senior year at high school. But the second 17-year period sees the Dow Jones Industrial Average grow tenfold from 875 to 9,181.43. That's a staggering contrast. So Buffett simply asks, what explains the contrasting market performance over these two distinct periods, the first 34 years of my life? It didn't have anything to do with the economy. During the first 17-year period, the economy actually grew at twice the rate it did during the second period. Buffett then cites the changes in the U.S. long-term bond yields and suggests a part of the answer might have something to do with the swings in the interest rates. He notes they went from 4.2% at the beginning of 1965, and then they peaked around 13.7% in 1981, the first 17-year period. Then they fell back to about 5.09% by 1998, the end of the second-year period. He provides this insight. In economics, interest rates act as gravity behaves in the physical world. At all times, in all markets, in all parts of the world, the tiniest change in rates changes the value of every financial asset. You see that clearly with the fluctuating prices of bonds, but the rule applies as well to farmland, oil reserves, stocks, and every other financial asset. That would include real estate holdings. According to Buffett, another factor that helps explain the divergent 17-year periods is corporate profits. He cites a 1922 study by Edgar Lawrence Smith, which suggested stocks will consistently outperform fixed income instruments because businesses retain earnings, which are then used to generate more earnings and dividends. So there's a compounding effect with businesses that one doesn't get with fixed income, and it's why stocks tend to outperform bonds over the long term. But note, when interest rates are higher, it has an adverse effect upon profits. Higher interest costs lower profit margins and dampen the compounding effect. That leads us to a third qualitative force acting upon the markets, namely investor psychology. Buffett notes people are habitually guided by the rear view mirror and for the most part by the vistas immediately behind them. In other words, most investors and portfolio managers tend to make decisions based on their most recent experiences. These days, behavioral economists refer to this as the hot hand fallacy. Now, Buffett doesn't mention taxes in his article, but I'm going to. It's a theme that he returns to time and time again in his annual letter to shareholders. In 2017, Congress rolled back corporate taxes from 36 to 21%. That gave an automatic 14% boost to every corporation's bottom line, buoying corporate earnings without any innovations or gains in productivity. So to quickly summarize, Buffett sees four forces affecting stock market outcomes. Number one, interest rates. Number two, corporate profitability. Number three, investor psychology. And number four, taxes. Now let's consider those four factors in today's market climate. On July 31st, 2020, interest rates were at record lows. U.S. 10-year Treasury bills were yielding 0.563%. Government of Canada 10-year bonds were yielding 0.467%. Just so you know, at those rates, your money will double every 1,484 years. Now, I'm all for taking the long-term view, but, well, never mind. Let's review the equity markets instead. On July 31st, the Toronto Benchmark Index was trading at 16,288. That's about 5% off its all-time record high. At that level, the price-to-earnings multiple was about 22.83. So, if the index traded like a listed business, current profitability would be about 4.4%. In the U.S., the S&P 500 index was trading at or near all-time highs at 3,270.45. At those levels, the largest U.S. companies are trading at about 28.6 times current earnings. That implies average corporate profitability of about 3.76%. And at those levels, your money doubles every, wait for it, 18 years and 9 months. So I want to reiterate Buffett's comments about the effect interest rates and corporate profitability has upon financial assets held in the stock market. The lower the interest rates, the higher the corporate profitability and the value of financial assets. Just for reference, here's what things looked like 10 years ago. Long-term bond yields and interest rates were already low, hovering about 3%. The S&P 500 was just coming out of the 2008 financial crisis, and it was valued about 1/3 of what it's valued at today. The Toronto Index was worth about 2/3 of what it was today. Now let's look at the psychological force and how that might be influencing the thinking of investors. For the past 40 years, industry professionals have been advocating asset allocation and the wisdom of putting a set percentage into cash, fixed income, and equities. It has been reinforced by compliance departments, rating agencies, and we see that reflected in how Canadian investors have invested their mutual funds. On June 30th, 2020, the Investment Fund Institute of Canada released the following information. About half of all assets were allocated into balanced funds, about 32% were invested in equities, about 14% were invested in bonds, about 2% were invested in specialty funds, and about 2% were invested in money market funds or cash. Here's a bit more context. For the past 40 years, as long-term interest rates have steadily declined, fixed income instruments like bonds and treasury bills have been a relatively safe haven while equity markets recovered. That thinking has been reinforced time and time again and now represents a sort of industry orthodoxy. So from a risk management perspective, what does that look like if rates start to rise? Well, those 10-year Government of Canada bonds, they start to lose value fairly quickly. If rates return to 3%, where they were 10 years ago, bond values would fall roughly 23%. Now, central bankers have been quite vocal about their intentions to maintain low interest rates, but their hands might be forced if defaults begin. What lender wouldn't demand a premium given a higher default rate? Still a bit more context. The longest bull run in equity markets has been extended by record low interest rates and a decrease in taxes. But how long will that, or how long can that last? Values would likely change drastically if rates increased, if taxes increased, or if both events occurred. Meanwhile, for the past 20 years, the Canadian index has been returning modest gains. And if we look back on 125 years of stock market history, there are periods where the equity markets take a long time to recover. And while I hate to drag politics into this, Canadian governments have been spending without a clear plan to deal with the COVID crisis. That leaves taxpayers with ballooning government deficits and a dire need for tax increases. To date, the federal government has yet to table a budget for 2020. So let's review. First, investors have ridden a 40-year bull market run with fixed income. Interest rates are at all-time lows, and while they could stay down indefinitely, should they begin to rise, you should expect the price of all financial assets to decline, perhaps significantly. Second, consumer debt is at an all-time high, and the potential for defaults has increased as the pandemic has been prolonged. Third, the near-term profitability of broader equity markets is minimal. Should rates rise, marginal companies would likely fail or suffer, and all companies will find stress on their bottom line. Fourth, if investors, managers, and central bankers are likely basing decisions on most recent experiences, they're likely to employ conventional strategies which may have little desired effect. And number five, if governments and central banks continue spending and propping up traditional programs, they will likely have to raise taxes in the future. That again will put pressure on corporate profitability. Here are some things you can do to help mitigate some of your risk exposure. Number one, stay liquid. Ensure you have access to cash or cashable investments. Mr. Buffett's sitting on $147 billion of cashable investments right now. Number two, pay down non-deductible and high interest rate debt. And when possible, lock in low rates for as long as you can. Number three, consider a Manulife One mortgage or a home equity line of credit against your house. Number four, if you or a family member requires income, consider purchasing an annuity. Rates are very competitive, and it's easy to obtain a quote. Number five, consider holding equity investments in segregated funds. They'll offer some capital guarantees on your investments, and they'll provide a higher degree of creditor protection should you need it. Number six, now is not the time to leverage or borrow money to invest in mutual funds or the stock market. Instead, consider securing sources of capital should opportunities present themselves over the next few years. So let's sum things up. In 2001, Warren Buffett published an article about the stock market. It's as relevant today as it was back then. In the article, Buffett demonstrates how market conditions are largely influenced by interest rates, corporate profitability, investor psychology, and different levels of taxation. He also showed how changes in rates could affect the underlying values of all assets. Investors should be aware of some of these potential risks and ways to help mitigate some of those potential hazards. For more information, see the links at the end of this presentation or to develop a prudent plan, contact me, Gordon Wiebe, via email at gord@think-income.com or visit my website at www.think-income.com. Thank you, and remember, please stay safe, stay sage, and stay well.